Good afternoon. This is Ken Long from Tortoise Capital with a review of the daily trading plan for April 23rd, 2013. I want to start off with just a review of a couple trade frames that we had prepared the night before to be ready to trade today. We're looking at an hourly charts here on TNA, triple leveraged Russell Long. And we're now looking at the last 2 days have stabilized and found support at 37.50, which is where the market sold off to from 44.50 as a consequence of the Boston bombing. So we call that the Boston bombing fail. And then over the weekend, they caught the guys, and it seemed like there might be a relief rally, and so we assumed for planning purposes that 37.50 at the red line would find support because it couldn't fail further, and we were anticipating a rebound rally, and which we called the ladder of recovery. And so we looked at some standard support and resistance marks, and so the purple lines reflect potential price targets if, in fact, we're going to see that ladder of recovery. We would expect hesitation at those lines, and if they did, we'd be cash in profits. If it blasts right through them, then we think it's relatively smooth running to the next purple line, and so we staged a number of potential decision points. And that's what we think of as trade framing. And this was a high priority trade frame for us because it represents what could be a 5 to 8% move in the market to retest previous swing highs. And if we can manage tight stops during the day, that would allow us to build up some capital that we could risk overnight with markets' money. The second trade frame is taking a look at CLF, Cliffs Natural Resources, a mid-cap natural resources company that is a trading favorite because it makes long, smooth moves with lots of volatility and is directional in both directions. And so this is 15 minutes and 4 days, and we've marked off the support levels in red, profit targets or price targets in purple, and we're anticipating standard decision making at each of those, and we traded that one successfully today based off of this trade frame. It ran all the way up and then all the way back down, and we were able to get it in both directions. So once the market opened today, it was a minor gap and then a grinding up day, which we found some gains in basic materials, XLB and XLF, the financials. And then around lunchtime, we saw a 10 sigma event, which you're supposed to see approximately never because it's such a rare event. And we saw a 10 sigma adverse move when someone had hacked the AP Twitter account, sent a false message out that Obama had been hurt in a White House bombing, and the market responded by instantly going flat, taking out all the liquidity, and then there was a 10 sigma move down, followed by a 10 sigma move up. We saw that spike at lunchtime as we were preparing for trades in the sideways quiet channel, which we go in either direction with tight stops. And when it blasted through the VWAP here, we said, something must be going on. What should we do? And we said, well, you can either go to the news and figure out what's going on, or you can trade the move. And we elected to trade the move. We had that conversation within about 30 seconds of the, at that point, a 5 sigma move happening. And so we waited for the bottoming tail. It turned around at 39.80. It moved a 50-cent move off that bottom. Bought it at 40.40 with a 50-cent stop, which would take it just below the bottoming tail. Within 30 seconds, the market had returned back to the Bollinger Band mean at the red line. That was 1.5 hour in hand. Seemed like a reasonable place to accept the gift and move on. And then we traded for the rest of the day once an order had come back to the market about 20 minutes later, and we just resumed our standard trading practice. And this is all about being prepared for moves, for having stops and entries in the market during sideways quiet channel, and then trading according to a plan. And keeping your risk measured. You can see a nice picture here, courtesy of Zero Hedge, that shows how the order book basically disappeared and the market went to zero liquidity very quickly. When the smoke had cleared and the market had closed, in personal trading today, trading in my usual way, I made a total of 37 trades today. My maximum win was 1.9, biggest loss minus 0.8, 22 wins, 5 scratches, 10 losses with a standard deviation of 0.65. About 2 to 1 winning trades and about a little under 2-to-1 average win to average loss. That produces a scatter plot of these trades through time. Most importantly for me, nothing under -1. And then we get a histogram of results that looks like this with a constrained left-hand tail, a normal distribution in the middle where I'm making professional money, and the possibility of fat right tails. Really didn't have any big tail winners today, but the cumulative R was basically smooth throughout the day, trading in a professional manner, and my rolling average R through time made me satisfied with my performance today. And that brings us into the market close with the review of the market health check here. This is a daily chart, looks back 4 months. And the vertical blue lines are 10, 20, and 30 days of look back. The horizontal red lines are support levels that were once resistance levels and are our price targets on the downside if the market collapses here. The purple line at about 160 is the recent swing high. And if the market gets above that and closes above that, then there's a possibility for another leg up. But in the meantime, we'll be tactical traders between support and resistance. We see that the river is up. The price just cleared through the 30-period regression line, which is the thick black line in the middle. The outer black lines are the channel formed by the maximum excursion during the look-back period, and so we're right in the middle of that regression channel, back to normal price conditions after the Boston sell-off. Price, in fact, just peaked out of the river, which is a favorable condition for the long side, which is good because ADX has pulled all the way back to 17, and today the bulls finally came back and met the bears, as you can see on ADX. And what that means is in a sideways trending market, there's room for a 5 to 8% move ahead. If that happens, we would expect price to go through the purple line and then have cleared all the resistance overhead, and then we're looking at another probably $10 on the upside in S&P, and that will reward any swing trades that are initiated now. You can see we've got a comfortable distance down to the 200-period moving average, and the slope of the regression line just got measurably better today. Even though it's positive, it's now getting stronger, and so this is the potential for a longer-term swing trade environment. Okay, shifting to the highlights of the daily report, we've got a bullish volatile market. On an annual basis, we're at 66 out of 100 with weekly RSI, about the midpoint of neutral. On a 10-day basis, using the 10-day NDX, we're at the high end of neutral with 69 out of 100. The percent stretch relative to the 200-period moving average is green bullish. That's very favorable, 9.37%. In fact, it just went green today, and that signals, again, the potential for a resumption of the previous bullish moves up. Slope of the 50-day moving average is still yellow neutral at 0.36%, but that's improving slightly, and again, makes the case for why there's room for it to continue to go. The risk index, which is the 30-period moving average of the VIX divided by the 10-period moving average, is at 0.94, and that's risk off, although you can see based on the z-score analysis it's actually starting to improve and a little bit of volatility is coming out, and that sets the stage for enough room for volatility to decline to support swing trades. And so this is very favorable for folks that can start off on day one with good trading techniques and grow the swing trades over the next couple weeks if the bull continues to unfold. On the downside, we've identified clear price targets, and we know where to find the evidence if the market is collapsing, and we have targets on the downside. But right now, this is moving into ideal territory for a swing trader. No signals for the overreaction and channeling system. You can see the references for daily pivots. You can see that volatility is at an extreme high here based on ATR percentage and the 6-month look back, and it's starting to roll over a little bit. You can see that ADX has bottomed at around 17, and the bulls have caught up to the bears. 10-day max pain candidates include trading favorites Hewlett-Packard, IBM. Watch IBM. It was outstanding today, and we're expecting second-day momentum on there. Had a great intraday trade pattern. General Electric, United Health, and Alcoa complete the top 5. Among the ETFs, it's the double VIX, gold, miners, silver, the VIX, and metals and mining. The winners, according to 10-day min pain, have been the usual suspects: Intel, DuPont, Merck, Disney, Johnson & Johnson. Among the ETF 100 includes semiconductors, consumer staples, XLP. No swing set, no pattern trade swing setups for the ETFs. Those were already hit earlier this week and last week. But among the large caps, we got channeling and overreaction in Hewlett-Packard, General Electric, United Health, and McDonald's for both of those systems. 5-day down patterns in General Electric, IBM, and McDonald's. That should be a high priority to frame is McDonald's. And then 551W in McDonald's. In the auto framer, these are all the symbols that based on trade location. On a test of the 10-day high with yesterday's low as a initial stop, these test out at better than 2-1, and some of them are double-digit goodness. So these should be on your short list as well. Silver, gold, IBM, blended commodities, General Electric, Hewlett-Packard, oil, coal, and McDonald's. So McDonald's, if you're not looking at McDonald's tomorrow, then you should consider doing so. Taking a look at the Dow Tactical Summary. The Max Payne range compression candidates, Hewlett-Packard, General Electric, IBM, United Health, and Alcoa. Most of those test out at better than 4-1. Hewlett-Packard at 4.4-1 is also a channeling and overreaction. General Electric should be on your short list. It is a doji, channeling and overreaction, a 5-day down. Number 2 on Max Payne range compression, tests out at 4.8-1 on reward to risk ratio, and had an RSI2 closing value of 3. So that is perfectly in the wheelhouse for a big one-day move tomorrow. Similarly, McDonald's, holy smokes, RSI2 value of 6. Reward to risk ratio of 3. It's a 551, a 5-day down, channeling and overreaction, number 1 on your hit parade. ETF 30, hardly any patterns today because of the size of the recovery has already made the easier money already in the bank. But under the auto framer, you should notice that gold and silver are testing out in double digits for reward to risk. Silver has the added advantage of being a 9 on RSI2 value. The rest of the auto framer top 5s and MPRC top 5s, oil, blended commodities, and coal. Energy sector should be of interest to you at 3-1, Brazil at 2.1-1, and then S&P Industrials, XLI. We would expect continued strength there. Financials were a key leader today. You can notice that they returned 1.8%, and between Europe 350, which also returned 1.8%. Those were the two big sector deals of the day. And that's the highlights of the daily report. That I'll stop there, and I'll leave the rest of the charts on with that you can stop and review. I would just want to let me comment about this one here. The Z-scores of swing gains. I want you to notice that Japan continues to be a country leader, and Microsoft and XLP are outstanding in terms of the returns that they've made over the last 5, 10, 20, and 40 days. On a Z-score basis, XLP continues to dominate, and Microsoft should also be on your short list if you're looking at the tech sector. So if tomorrow continues with second or third day momentum and technology is doing better than the market, you should look quickly to IBM or Microsoft in order to pile on to that sector for the new company leaders. That's everything from Raleigh. This is Ken Long at Tortoise Capital. Keep your powder dry and your risk measured.